Welcome to the ABM Crash Course day number 5, and our topic of discussion today is unit number 21, which is based on credit delivery and straight through processing. As you know, in our crash course, our methodology of learning remain the same. First of all, I provide you videos that is approximately of 30 to 40 minutes. After videos, you start solving the quizzes or you start solving the MCQs PDF, and after doing that, you completely, if you see your score, if you get 60 marks, right, if you get 60 marks, then it means at least 60 marks, then it means you have a command over that chapter. And if it is less than 60 marks, then you again go through the content and again give the quiz. So this way you progress on daily basis, and it hardly takes 1 to 2 hours on daily basis. So I hope you are doing this on regular basis. So let's get started with our today's topic, and everything is in the pictorial format so that you can easily understand. So friends, now you can see, so let's break down the loan document execution steps, execution process step by step. First of all, it all starts with the borrower, right? So basically, borrower who signed the essential loan document, this kick start the entire lending process. Next, the guarantor steps in. So basically, by signing the document, the guarantor agree to share the liability, standing shoulder to shoulder with the borrower. Then once these signatures are in place, the charge is created over the primary security. As you can see, it means that this charge legally secures the lender interest in the borrower asset. Moving forward, the owner of the collateral. So owner of the collateral sign. So if it is someone other than the borrower, also sign all the relevant document to formalize the collateral agreement. Interestingly, if the collateral owner is not the borrower, they not become a guarantor. If the collateral owner is not a borrower, then they become a guarantor by default, adding an extra layer of assurance for the lender. Finally, everything is wrapped up by following a standard legal documentation. Right, a standard legal documentation, the usual set of paper which is used for most loan. So each step ensures that loan is legally sound, secure, and ready to be disbursed. So that is the meaning of loan execution, loan document execution process. Now let's move to the next slide. Let's look at the credit document processing sequence. So friends, let's explore the credit document process sequence, a crucial path that ensures a smooth credit documentation. Step number 1, as you can see, is ensure proper stamping. So before everything else, verify that all documents are properly stamped. This is a legal must do before moving ahead with execution. So first of all, you do the stamping. After doing the stamping, then you do the execution. That is the first point. Now with the step number 2 is to verify the authority to sign, which means check if the people signing the documents have the legal authority and the capacity to contract. This step safeguard against unauthorized commitment. And step number 3 is to complete document before signing. So before putting pen to the paper, make sure every section of the document is fully completed, no blank, no missing information. And then you have to register the charges with the ROC. That means, ensure that all documents are registered with the sub-registrar within the legal prescribed time frame to make them enforceable. So this is the point. So ROC within 30 days. So register any necessary charge with ROC within 30 days. So remember this deadline, 30 days is very, very important, and complete registration of the document with sub-registrar within the time frame. So each step matter. It's about making the document legally valid and protecting all the parties who are involved in this particular legal transaction. Now then we move forward to the next topic, which is the asset registration overview. So in this particular diagram, you will be able to understand, basically we will able to clear look at the asset registration overview, a key step in securing asset legally. At the heart of this process, we have various type of asset registration, each protecting a different category. So the first kind of charge you can see is called the mortgage charge. So basically, mortgage charge need to be registered with CAIIB. I think you know CAIIB. That is the Central Registry of Securitization, Asset Reconstruction and Security Interest of India. So remember, mortgage charge has to be registered with CAIIB. Then we have something called security interest. So again, beyond mortgage, other security interests are also registered with CAIIB, ensuring transparency and legal enforcement. What about the vehicle charge? Try to understand. When it comes to vehicle, registration of the charge is done through the Vahan portal. So there is a site which we call Vahan. Through this site, registration of vehicle is done, which is an India National Vehicle Registry. Then what about aircraft? So aircraft, yes, even aircraft charges are registered, but this time with the DGCA, right? So the Directorate General of Civil Aviation. What about the ships? So friends, finally for the ship, these are the assets. So the asset for ships, registration happened with the Mercantile Marine Department. right? Securing the lender interest in the maritime asset. So all the registration work like an umbrella, offering legal protection to lender and stakeholder across various industry. So I hope that makes sense. Different kinds of asset registration, I have made it clear to you. Please hit that like button if you really think that this concept is helpful to you. And friends, if you want such type of content for each and every unit, you can enroll in our CAIIB Crash Course program, which I have just launched, and this will help you cover the entire syllabus, all the important part of the syllabus in a very small amount of time, right? So to get more detail, you can WhatsApp me on this particular number, because the video you are seeing is just a part. The entire video is available in the Crash Course program. Now let's move to the next part. The next part that we have, let me show you. So this is the next part. Should personal guarantee be required for loan security? So this is the question. Now let's address a critical question in the world of lending. Should personal guarantee be required for loan security? On one hand, personal guarantee are often required for company where promoter, director or trustee have limited or no liability. Often what is happening, that on one hand personal guarantee are required. Yes, personal guarantees are required for those company where promoter, where director, where trustee have limited or no liability. In such cases, bank insists on personal guarantee to make sure these individuals are held jointly and severely responsible. It is a way to safeguard the bank interest when corporate liability is limited. So again I am repeating, yes, personal guarantee is required for loan security in those cases where promoter, director, for those company and entity where promoter, director or trustee have limited or no liability, right? So in this case, bank insists on personal guarantee to make sure these individuals are held jointly and severely responsible, right? But on the other hand, personal guarantee may not be necessary in the case of sole proprietorship, partnership, right? Because owner already have unlimited liability, meaning their personal asset can be attached directly, right? So in this company cases, they were having limited liability, but in this case, they have unlimited liability, like proprietorship, partnership, personal guarantee of owner. So it's not necessary, because their unlimited liability allow attachment of the personal asset. So but wait, there is more to it. Let's dive deeper into when personal guarantee plays a key role in the credit delivery. So let's look at the next slide. Should a personal guarantee be required for credit delivery? So friends, see, there is a point. There is something called closely held company. Try to understand. Closely held company. Personal guarantee, it helps ensure continuity in management and act like a cushion to protect the bank interest. So for closely held company, yes, personal guarantee is required. For delays in asset charge. So what happens, sometimes asset charge may get delayed. Personal guarantee provide a temporary layer of security to the lender during this delay, because I told you now that asset has to be registered, has to be charge has to be created over asset, and to whom charge is to be created, I just told you. For mortgage there's a different, for SARSAI, right? For mortgage SARSAI is there. For different kinds of asset category, different charges have to be registered, right? But suppose delays happen, then what to do? Then this personal guarantee will help you, right? And then the public company with weak financial, right? This is the case. So when a company financial strength is questionable or cash flow is unstable, personal guarantee act like a critical risk mitigator, right? So there we have to do it. And finally we have subsidiary with weak financial. For subsidiary that are financially vulnerable, guarantee safeguard against unexpected default. So while personal guarantee are not always mandatory, they are a vital tool when risk factor arise. So that is the point which I have answered, which I have raised, explained through this particular diagram. Now let's shift to our focus to the next diagram, which is, should exception to the prohibition or remuneration for guarantee be allowed? So let's try to uncover it. So friends, let's tackle a tricky question now. Should exception be allowed to rule that prohibit remuneration for guarantee? Should exception be allowed to that rule? There is a rule that prohibit remuneration for guarantee. Should exception be allowed to this rule? So it's like standing at a crossroad, two paths, two perspectives. So the first says that allow exception. You can see on the left side it says that yes, allow exception. So in some cases, exceptions are permitted. Imagine a situation where the guarantor are no longer part of the management, yet their personal guarantee still protect the bank. In such scenario, allowing remuneration can make sense as it compensates for the ongoing risk they bear even without having active role. And second case, do not allow exception. On the flip side, many believe that we should stick strictly to the rule. Why? To avoid any potential misuse or ethical concern that could arise if exception become too common. So this strict approach ensures integrity of the prohibition is maintained. So what do you think? Should flexibility be allowed, or should we stay firm on policy? So this is a classic debate between pragmatism and discipline, both having valid reasoning depending on the context. So on one side you say that yes, allow exception, right? Means rules that prohibit, there is a rule, right, that prohibit remuneration for guarantee. So but sometimes you can allow, right? For example, I've given you the situation, right? Suppose a situation where the guarantor are no longer part of the management, so yet their personal guarantee still protect the bank, right? So this situation I have told you, this is an exception which is allowed. Now let's shift our focus to our next slide, and in the next slide we are talking about managing working capital in sole banking arrangement. Very very important discussion we are going to do. So friends, you know how working capital is managed under a sole banking arrangement. First of all, everything is initiate sole banking arrangement. So this is the first point. Initiate sole banking arrangement means the business manages working capital through a single cash credit account. So there is a single cash credit account through which the business manages working capital with one bank. So business has a cash credit account, or we call it CC account, with a bank, and through which this working capital is managed. Simple and centralized. Then route transaction through bank, which means not all your business transaction, inflow and outflow, are route. Sorry. Next point is that all your business transactions, whether inflow, whether outflow, are routed exclusively through this bank. This gives the bank full visibility of your cash flow. Then open account with other bank. So, but wait, what if you need another account? You will need formal approval from your sole banker before opening account elsewhere. It keeps the bank in the loop, and then you have to obtain periodic statement. So then regular financial statement comes into play. So these report help the bank monitor your drawing power, right? So they can monitor your DP. DP is called drawing power, ensuring that your cash credit usage stay within the sanction limit. For every cash credit account there is a sanction limit, and to ensure that your utilization, your cash credit uses stay with that limit, DP is used. DP is called drawing power, and for that you have to give the periodic statement, right? So based on your periodic statement, your DP is decided. This is very very important point. And regulate cash credit utilization. Basically, it's all about discipline. Maintaining credit uses strictly within the approved limit is the key to maintaining a healthy financial profile. And finally, how do we derive the DP? I will tell you the formula to calculate DP. Just right now, listen to me carefully. How is this DP calculated? So basically, bank assess your current asset, current liability, using monthly stock statement. So you submit your monthly stock statement, then bank assess what is your current asset, what is your current liability, right? Based on your monthly stock statement, based on your book debt, based on your sundry creditor. So applying margin to figure out your drawing power. So on all these things, your monthly statement, book debt, sundry creditor, some margin is applied, and then drawing power is derived. So at the end of this video, I will tell you a numerical based calculation based on the drawing power. So stay tuned till the end, and I will explain how to solve question based on drawing power. This is most frequently asked in numerical type. Now let's focus our attention to our next topic, that how should working capital be allocated to stabilize funding use. This is a very important discussion we are going to do. So let's explore two common approach. The first approach, we have the cash credit focus. On the left side we have the cash credit focus. So the question is how working capital be allocated to stabilize fund use. So this method offer flexibility. When I say cash credit focus, it offer flexibility. Borrower can dip in and out of fund as needed, but there is a catch. It may result in fluctuating utilization and unpredictable cost, right? So borrower can dip in and dip out fund as needed, right? They can withdraw, and they can deposit the fund as and when required, but it may result in fluctuating utilization, right? It may result in fluctuating utilization, right? Of what? For fluctuating utilization and unpredictable cost. So during period of tight liquidity, borrower might max out their limit, causing bank to face high short-term borrowing cost. But during slack period, low utilization leave idle fund lying around, a double-edged sword, right? So basically what is happening? So there are two periods, right? So there is a period called tight liquidity, right? So there is a period of tight. So depending on which kind of situation is it, let me explain. So depending on which kind of situation it is, imagine a bank give loan to business through something called credit limit, like a credit card, but for company, right? So there is a period called tight liquidity period. Try to understand, this question was asked. So suppose there is a tight liquidity period. So tight liquidity period means money crunch time. When the market is short on money, that is called tight liquidity. Company will quickly use up all the money available to them under their limit to survive the crunch. Now the bank suddenly need more cash to meet this high withdrawal, so it may have to borrow extra money at higher interest rate, increasing their short-term borrowing cost, and this eats into bank profit. And sometimes there is a slack period. Slack period means what? Try to understand. Slack period means when the market is flush with the cash. This is called slack period. So company don't need to borrow much. So the bank fund are just sitting idle, earning little or no return, while the bank is still paying interest to depositor, is still paying interest to depositor or other obligation. So in tight time, higher cost due to borrowing. See what is happening in the tight liquidity time, higher cost because the bank has to borrow the money, right, at higher interest rate, and the slack time, the lower income because the money is idle, right. So the bank is stuck both the way. That is called double-edged sword. It struggle either with higher cost or with low return depending on the market condition. So that is the cash credit focus. That is the point of understanding the cash credit focus. I hope that makes sense to you, right. So that is the point of understanding cash credit focus. Now let's look at the other side. There is a fixed term loan allocation, right. So you can see, and then the point of cash credit focus, what we have learned, that during period of tight liquidity, borrower might max out their limit, causing bank to face higher short-term borrowing cost, and during slack period, low utilization leaves idle fund lying around and double-edged sword, because fund is lying idle, and from where the fund are coming to bank? Obviously from the depositor, and bank is paying interest to the depositor. So this is called double-edged sword. This question was asked last time. Then there is something called fixed term loan allocation. So this strategy brings stability. Yes, it brings flexibility, right. This cash credit focus brings flexibility, but this fixed term loan allocation, it brings stability. Why it brings stability? Let's try to understand. Because by combining both fixed and flexible funding component, business can smooth out cash flow ups and down. The result is that lower idle fund reduce borrowing cost also reduce, and much and more predictable fund uses. So which part should you choose, the flexibility of cash credit or the stability of fixed term loan? Because whenever bank offer fixed term loan, then by combining both the fixed and flexibility, right, it combine both fixed and flexible component. That is the point, right. So this is the point which I want to raise through this particular. So the question was, how should working capital be allocated to stabilize fund uses? By using this fixed term loan allocation, right. Now the next question is how to structure working capital limit for borrower. So when it comes to managing borrower, a crucial question arises, that how do we structure working capital limit effectively? So let's break it down step by step. There is something called loan component. So remember, for large borrower with working capital limit of 150 crore and above, right, it is essential at least 60% of this limit is structured as loan, and yes, there is a flexibility to increase it further, right. Again I'm repeating, for large borrower means those who have working capital limits of 150 crore and more, right. These are called large borrower. So it is essential that at least 60% of this limit, suppose the limit is say 200 crore. What is 60%? 60% is 120 crore. At least 120 crore should be as loan, right. At least 120 crore should be as loan, right. So basically, and it can be extended further, it can be increased further. A second way to structure working capital limit for borrower is to include commercial paper. So if commercial paper are sanctioned, they must be counted as a part of loan component, right. They must be counted as part of loan component. It ensures proper integration within the borrower working capital, and you have to exclude certain credit. So but don't forget, export credit and inland sales bill limit are excluded from the loan component calculation. So basically what we talk about the loan component calculation, the first thing that loan component should include for borrower having working capital limit of 150 crore and more, they should have 60%, at least 60% should be the loan component. Second point, any commercial paper should be part of the loan component, and we have to exclude some kind of credit like export credit, inland sales bill limit outside of the loan component. So that is the point which I have explained, how to structure the working capital limit for borrower. Now let's shift our focus. So friends, now let's walk through the loan structuring and management process step by step. So determine loan amount and tenure. So start with consultation, right. First start with the consultation, right. Finalize the loan amount and the tenure, which must be at least 7 days. So this should take at least 7 days. Loan amount and tenure, with you consult with the borrower to set loan parameter, loan amount and tenure. Then you structure the multiple loan, which means design loan with varying maturity to balance flexibility and repayment timeline. Now you ensure the RBI compliance. All consortium lenders. So basically this point is about the consortium. You know about this consortium thing, right? So how consortium works, that is the point I am talking about. So basically all consortium lenders must stay in sync with RBI guideline. Then individual bank responsibility. Basically what happen, whenever multiple bank arrangement is there, MBM is multiple bank arrangement. So whenever multiple bank arrangement is there, each bank within this MBA is responsible for managing it on compliance independently. Then you set the repayment terms, means fixed repayment schedule, whether it is via installment or bullet payment based on borrower need. You know what is the meaning of bullet payment? It means the entire payment will be paid at the end of the repayment terms. And finally apply rollover option. So consider rollover option, ensuring they comply with the IRAC norms. So income recognition and asset classification norms. So a systematic approach like this helps stabilize the borrower cash flow while keeping the lender risk in check, right? So that is the point. So this is how loan structuring and management process is done. Now let's look at the term loan disbursement process. So friends, let's explore the term loan disbursement process step by step. First of all, it all begins with the borrower contributing their share upfront, which is called margin, right? So borrower deposit margin, right? So this margin ensures the borrower has a skin in the game before the bank move forward. Then bank debit the loan amount. So it means once the margin is secured, the bank debit the full loan amount from its own account to get ready for the next action. Then bank remit payment to the seller. So next the bank take charges and directly transfer the fund to the seller on the behalf of the borrower, ensuring a smooth and secure transaction. Then there is a proof of partial payment, which means in certain cases if the borrower has already made partial payment to the seller, the bank will require proper documentation as proof before disbursing the remaining amount. And then you have direct credit for personal loan. So and if it is a personal loan, the process is simple. The sanctioned loan amount is directly credited to the borrower account. So whether it is a business transaction or a personal need, this process ensures that disbursement is secured, systematic and hassle-free for both borrower and the lender. So this is how the term loan disbursement is done. A step-by-step process I have told you. Now let's shift our focus to the next topic, which is the project loan disbursement. How project loan is disbursed. Let's look at it. So let's decode the project loan disbursement and equity infusion process. So it all kicks off with when the bank decide to disburse the project loan, right? Setting the wheels in motion for the funding the project. It's called initiation. Then we have step number 2, that is promoter equity infusion. What it means? So basically promoter now steps in and select an equity infusion strategy. So there are some methods. Either they can opt for full upfront contribution, or they can opt for partial initial contribution, or they can opt for proportional infusion alongside the loan, right? So what is the meaning of this full upfront partial? Let's understand. So if it is full upfront contribution, it means promoter contribute the entire equity amount at the very start of the project. This shows a strong promoter commitment and boosts lender confidence, right? So basically promoter, in this case full upfront contribution, promoter contribute the entire equity amount at the start. And then if it is a partial initial contribution, so promoter contribute 40 to 50% of the equity initially upfront, with the balance infused as the project progress. So as the project progress, balance amount is infused. And if it is a promotional infusion, it means that this is a balanced approach where the promoter inject equity in phases. So this is called phase-wise injection of equity, right? So basically what happened in proportional infusion, that it match with the bank financial throughout the process timeline. And there is something called debt equity ratio policy. Try to understand what is the meaning of this debt equity ratio policy. So friends, that bank apply a strict DER policy. This is called debt equity ratio policy, right? This policy is strictly applied especially in the project loan, ensuring the right balance between borrowed fund and the promoter equity, right? And it ensures compliance. So finally bank actively monitor and make sure that promoters contribution align within the agreed DER at every stage of the project. So this process ensures transparency, discipline and sound financial health for both the bank and the promoter, right? So that is the point which I make to understand using this particular diagram. Now let's shift our focus to the next diagram, that which banking arrangement should be chosen for financing. So confused about which banking arrangement to choose for financing? Let's simplify it for you with these 3 common approach. The first approach is called sole banking. So basically, if your funding need fall within the limit of a single bank, every bank has a limit on how much they can lend to a single corporate borrower. So if it fall between the single bank limit, then it is straightforward. Sole banking is the way to go. It is straightforward and ideal for a smaller project that don't require multiple lender. Second option you have is consortium banking. Basically, when the financial requirement is larger, you will need multiple bank to pitch in. Here one bank act like a lead bank. So basically this is the concept of lead bank, right? And they lead to coordinate the entire loan structure. This is called consortium banking, perfect for large scale project where teamwork among the bank is the key. And the last thing we have is multiple banking. So basically if you want more freedom, multiple banking offer flexibility. No formal coordination between bank, but you can tap into several banks separately, managing each loan individually. So it all depends on your project size, risk appetite and how much coordination you are ready to handle, the types of banking arrangement you have to choose, right? So sole banking, either you have consortium banking you have, or multiple banking you have. Now let's shift our focus to the next topic, which is loan syndication process. Very important topic. So ever wondered how loan syndication really work? Let me walk you through this step-by-step journey. So it all starts with the borrower select a trusted lead bank to arrange the loan. So there is a lead bank, borrower trusts them to arrange the loan, right? So think of this as the bank as the captain of the ship. Now the lead bank reaches out to other bank to form a syndicate, right? This is the second step. because big loan often need multiple player working together. Then what the bank do? Bank assess proposal, which means each bank in the syndicate review the loan proposal according to their own credit policy. Every bank has their own credit policy, you know it, right? And since bank has their own credit policy, so what happened, each bank in the syndicate review the loan proposal. This is where they decide how much they are willing to contribute, and then lead bank coordinate the process. So basically once commitment are in, the lead bank takes charge and manage the entire syndication process and negotiate terms with all the parties. And finally, meeting organized among banks. So the lead bank organize formal meeting with all participant bank to finalize agreement and iron on any detail. And finally, syndicate fee is charged. So for all this coordination, the lead bank charges syndication fee for its service. So it is all about collaboration, coordination and confidence, right? So this is how it is done. So I step by step process I have told you, a lead bank, a syndicate bank, how it works, every aspect we have covered. Now there is something very very important. So friends, with the rise of STP, you know what is the meaning of STP? STP is called straight through processing. Remember it. This is called straight through processing. So with the rise of STP, right, and CUE, that is called credit underwriting engine, the entire loan cycle from application to disbursement is now highly automated and cutting down manual work and boosting speed and efficiency. So how it works. So so basically let me tell you what automation of the loan processing. In this slide you can understand it, right, how it get automated. First thing is that loan application is received, right, which means this journey begins as soon as the loan application is received. Then automated processing initiated, no waiting around, the system automatically starts processing the application in real time. Then compliance check performed. So basically automated tool jump in to conduct regulatory check, ensuring everything complies with the rule. Then decision making process. So basically the system now evaluate the application, make decision based on the preset logic and credit rules, fast and objective. Then loan is sanctioned. Basically once cleared, the loan gets sanctioned through automated approval workflow, and disbursement process begin. Funds are ready to flow. The system initiate the disbursement process efficiently. And minimum manual intervention. So the best part is that human involvement is very minimal. Only a few essential tasks are left for manual handling. So what is used to take days or weeks can now happen in hours thanks to automation. So you can see, using automation, the entire process of loan disbursement, loan sanctioning process, everything is getting automated, right? And this is thanks to STP, that is straight through processing, and CUE. This process has now is automated. Now, so friends, let's look at the credit risk mitigation process. So friends, that now that we have automated loan processing, so let's talk about something equally critical, which is mitigating credit risk. With loan expanding beyond personal finance into MSME, commercial sector, managing risk has become more sophisticated. Here is how banks are stepping up their game with technology. First thing they do is the data integration, which means that this comes with the power of first all borrower information is gathered and consolidated into one unified system, no more silos. Then we have AI analysis, which means this is the power of artificial intelligence. AI drive deep into borrower behavior, analyzing pattern that a human eye might miss. Then anomaly detection. So means automated tools detect any kind of irregularity in the data, like red flag, before they become real issue. Then we have risk assessment. With insight in hand, the system now evaluate potential risk linked to each loan, whether it is personal loan or a business facility. Every file is put under the risk radar. That is called risk assessment. And then step 5 is to inform decision making, which means finally bank based on all this data and analysis, bank can make a smart, confident lending decision. So from data collection to risk informed approval, thus funnel ensure that lending is safer, faster and smarter. Right, so this is how. Now let me show you the next slide, and I will tell you how to calculate the drawing power. This is very very important. Drawing power. Let's break down how bank calculate drawing power for a business under cash credit limit. So this is the topic from where numerical question is asked in every examination. So friends, imagine a business had been sanctioned a loan limit of 500 lakh. Suppose sanction limit is 500 lakh. Okay, but wait, the bank won't just hand over the full 500 lakh immediately. Bank first check two key things. The first thing that bank check is the stock the business has. What is the stock value of the business? In this case, it is worth 400 lakh. And also the bank checks the book debt. What is the meaning of book debt? You know the meaning of book debt. Book debt means the business unpaid customer invoice. So some invoices had not been paid by the customer. So this is called book debt. Business unpaid customer invoice. So which is left pending of the customer payment amount. So which is how much? 300 lakh. Right. But there is a twist. bank apply a margin, that is like a safety buffer, right? So on stock, the bank apply margin of 25%, and on the book debt, bank apply margin of 30%. So more margin on book debt because risk is higher there, right? So basically, first of all, step number one, so such type of thing will be given into the question. You will be given sanction limit, you will be given stock value, you will be given book debt, right? And obviously margin on stock and margin on book debt, right? And the business has a stock worth 400 lakh, but it also owes rupees 100 lakh to creditor. Yes, it owes something 100 lakh to the creditor, means it has borrowed money from creditor and not paid yet. It is still remaining to be paid, right, for this stock. So the paid stock, so how much he had paid? Tell me, out of the 400 lakh, how much he had paid? The 300 lakh he had paid, right? So it is clear. Let's try to understand. Let's see the next step. So total stock is how much? Total stock is 400 lakh. Creditor is how much? Creditor is how much? 100 lakh, right? So creditor means the amount which is still to be paid. So what is the paid stock? How much is the paid stock? It is nothing but the 300 lakh. Now you have to apply the 25% margin. I think why I have taken 25% margin, because margin on stock is 25%, right? So margin on the stock value, so I have subtracted 400 lakh minus 100 lakh, that is the paid value. On paid value only I am taking this 25%, right? Bank will not care about this creditor part, right? Bank will pay, margin will be taken only on the paid stock, that is 300 lakh. So what is the 25% of 300 lakh? So 1/4 of 300, which will give you 75 lakh. So this 75 lakh is the margin, which is the borrower contribution, right? And then remove it. So after removing this 75 lakh, bank will pay 225 lakh. This is the drawing power, right, from the stock. And now let's look at the book debt. I told you there is a two type of thing. One is the stock and other is the book debt, which means book debt means that this is still मतलब कि ये उधार लिया गया था, इसको वापस लेना है कंपनी को, right? Company has given some amount, some goods or some services to the customer on credit, and later they will accumulate, later they will collect payment from them, and it is still it has not been collected. How much amount has not been collected? So amount 300 lakh has not been collected, means 3 crore has not been collected, right? So basically the unpaid invoice, also you call it unpaid invoice, are 300 crore. And what is the margin on that? Margin on is 30%. So just calculate 30% of 300 lakh, which is how much? 90 lakh. So this is the borrower contribution. This bank will not give, borrower has to contribute it. So bank will subtract it, and the drawing power will be 210 lakh, which is 2.1 crore. So final drawing power is 225 lakh here and 210 lakh here, so which is nothing but 435 lakh. So although the bank sanctioned, how much the bank has sanctioned? See, the bank has sanctioned, bank has sanctioned 500 lakh. This is the sanction limit. Although the bank has sanctioned 500 lakh based on the business stock and receivable, the company can actually draw 4.35 crore at this point, right? It is how banks stay cautious and protect themselves while still helping business run smoothly. This is the how. This is done on every monthly basis. Whenever you submit the stock statement, bank see the stock, bank see their stock, bank see their book debt, and do this calculation and decide their drawing power, and they ensure that the maximum credit which is allowed to them stay within the drawing power, right? Now let us look at one more question. This will clear up your concept more. So let's look at this particular calculation. So friends, we are asked to find the drawing power. Some information given you: sanction limit is 20 lakh, security value is 30 lakh, margin is 25%, right? Margin is 25%. So basically when I say stock, what is stock basically? So stock is a kind of fixed asset, right? Stock is a kind of fixed asset. So based on which the bank give this particular loan. This is called the security value. So its value is 30 lakh, margin is 25%. So the formula is quite simple. DP is how much? So DP is the security value minus margin, right? Like in the previous case, that is what we have done. So we have taken stock, we have taken book debt, and we have applied margin on them, and that is how we have calculated the drawing power, right? So this is all decided on basis of the security value. So security value here is how much? 30 lakh. And how much margin is there? 25%. So just what is 25% of 30 lakh? So this is 1/4 of 30 lakh. So 1/4 of 30 lakh, 7.50 lakh, 7.5 lakh. 7.5 lakh is your margin. Just subtract this from 30 lakh, you will get 22.5 lakh, right? Yes, but here is the twist. So DP we are getting how much? 22.5 lakh, and sanction limit is just 20 lakh. How can your DP greater than sanction limit? Your DP cannot exceed the sanction limit, which is 20 lakh. So even though we calculated 22.5 lakh, the bank will restrict DP to the sanction limit. So the final drawing power will be how much? 20 lakh. This is how bank protect their risk, by capping DP within their sanction limit, right? So I hope that makes sense to you. And this was same thing which I want to explain to you here. just let me come back to this particular point where I told you, right, that we will discuss it later. Here you can see calculating drawing power from current asset and liability, right, and on monthly statement of the stock, book debt and sundry creditor. And I just now I have seen how to apply this creditor. First of all, we subtracted the creditor amount from the stock statement, right, because that is the paid amount, and on paid amount we apply the margin. Similarly, on book debt we apply the margin, right, and then we calculated this particular DP, right, and margin are applied to this to determine DP, right. And I told you drawing power regulate cash credit utilization within the sanction limit. So drawing power should always be less than or equal to the sanction limit, right. You cannot utilize more cash credit than drawing power, even though in this question what I see that the sanction limit was how much. Sanction limit was, it was 500 lakh, which was 5 crore, but still company can actually draw maximum 4.35 crore at this point. So the drawing power varies. So that is the whole point of this lesson. Hopefully you enjoy the session. I have made every concept clear. If you really enjoy it, please hit the like button. Do enroll in our course. If you want to enroll in our CAIIB Crash Course, we provide you such kind of content in explained in such a lucid manner. WhatsApp me on this particular number for any detail. Thank you.